Let's talk about banks, and not just any banks, but the top Chinese banks. First and foremost, as a form of diversification in terms of sector, and more importantly, if your portfolio is concentrated in a certain country, your own country for example, then you may want to diversify out to reduce some risk and to gain some exposure. After all, China is one of the world's fastest growing economy and also the second largest economy after the US. Next, banks are quite undervalued right now, as you will find out in the analysis later. This offers a great opportunity to accumulate cheaply with regards to value investing. Banks also offer a high dividend yield, and good news to foreigners, there are no withholding tax for dividends, unlike in the US. And lastly, you can trade options on these Chinese banks. Unlike Singapore banks, where you can only wait to buy or buy and wait to profit. With options, we'll be able to collect premiums through strategies like the wheel strategy. While waiting to buy, we are able to collect some money. And while waiting to profit, we will get to collect more. It's akin to being paid for waiting. And this could boost your investment returns tremendously over time when done right. You can learn more about options trading under our options trading course. And specifically in these two videos, I've shared about the rules and risk to look out for when executing this strategy. With that, let's get into the analysis itself. For those who are new to the channel, I will be basing the analysis on the value investing strategy that I've been using, with some tweaks to step 6, and I'll also be taking into account the dividend aspects of these banks. For our first bank, we'll be looking at ICBC, the Industrial and Commercial Bank of China. And to get the relevant data, we'll be relying on several websites. The first one will be aastocks.com, and you can key in the ticker symbol under here. For ICBC, the ticker symbol is 1398. After that, you want to go over to fundamentals, and you can look up the company profile and the corporate information to find out more information about this company if you are interested. Under those two sections, you will get to see a brief summary of what the company is doing and so on and so forth. Alright, so for the analysis of these companies, we'll be focusing more on the fundamental data. And for our first step, we want to ensure that the company is having increasing profitability over the last 5 years. For that, go over to profit and loss. The first financial figure that we are interested in will be the total turnover, which is also known as revenue. And this is what we want to see. For the past 5 years, revenue has been increasing steadily year on year, and that is perfect. Scroll down further, and the next figure that we want to scrutinize on is the net profit. Likewise, we want to see that for the past 5 years, it has been increasing steadily. So another pass for ICBC. Lastly, go over to cash flow, and we are expecting the same trend from the net cash flow from operating activities as well. For this figure, we can see two anomaly years in the records of ICBC. 2015 is exceptionally high and 2016 is exceptionally low. So even if we average out the results for these 2 years, the net cash flow from operating activities for ICBC would still be rather flat and not increasing consistently for the last 5 years. So for this, we will rate it as a fail. So just keep this in mind as we progress through the rest of the analysis. For the second step, we want our company to have a high growth rate, ideally a double-digit growth rate. For growth rate, we can head over to Yahoo Finance. Likewise, key in the ticker symbol 1398. Look for the analysis tab and scroll all the way to the bottom. So under growth estimates, you will be able to see the growth for the next 5 years per annum. The analyst has derived at a rough growth rate of 6.37%. Other than Yahoo Finance, you can also get this projection from Simply Wall Street. So over at this website, go over to the fourth section, Future Growth. Under Simply Wall Street, they have estimates from 20 analysts that is based at a 4.5 annual earnings growth. But take note that for Simply Wall Street, their growth rate is only for the next 3 years, unlike for Yahoo Finance, which is the next 5 years. So just something to bear in mind when you conduct your own analysis. But nonetheless, the figures from these two sources are still rather close. So overall, it is still less than the ideal double-digit growth that we are looking out for. But this shouldn't come out as a surprising fact. After all, these banks are large, stable companies, and the investment thesis for going into them will be focused more on the dividend yields instead of their growth potential. But we will still keep this figure in mind and conduct a comparison across the different banks that we will be analyzing today. Next, we have come to our third step of the analysis, which is to ensure that these banks have competitive advantage in their respective industry. And for competitive advantage, we'll be going over to investing.com, go over to financials, and look for ratios. Once at the respective page, scroll down. We want to look at the gross margin trailing 12 months as well as the net profit margin trailing 12 months. The left-hand column is the figures for the company itself, and the right-hand column is the average of the industry. So what we want to see is that for these two figures, the company's margin is larger than its industry average. And for banks, because they have no cost of goods sold, there wouldn't be a gross margin figure. So for this step, we'll only be relying on the net profit margin. And for ICBC, we can see that the net profit margin standing at 39.12% is indeed larger than the industry average of 36.81. So in this sense, we say that ICBC is outperforming its peers in the banking industry. Still on investing.com, we are going to scroll down further and look for our fourth step, which is to ensure that the return on equity of the company is more than 15%. And for ICBC, it is lacking slightly at 11.98%. So this is also a fail for the fourth step. Lastly, we want our companies to have a reasonable level of debt. For this step, we will have three sub-criteria. The first one would be to look at the current ratio, and we want current ratio to be more than 1. But for banks, again, they have no current ratio rating. So this sub-criteria could not be used. Next, we want to look at their debt to equity ratio. And for this, we will go back to our aastocks.com. We will go over to balance sheet. So under balance sheet, scroll down, and what we want to look at is the total liabilities to the total equity. So for ICBC, the debt to equity ratio is about 27 billion divided by 2.6 billion, and this gives us a debt to equity ratio of about 10.2 times, which is definitely way above our threshold value that we can accept. Ideally, we want the debt to equity ratio to be less than 1. But during times of low interest rate like the current situation that we are in right now, it is understandable that companies would like to take on more debt to finance for their growth. And therefore, debt to equity ratio for most companies is more than 1. Nonetheless, at a reading of 10.2 is way above comfort level. So this step, we rate it as a fail as well, but keep it in mind as we compare it against the other banks. Lastly, we want to look at the debt servicing ratio of the company. And for this, we will be taking the interest expense divided by its cash flow from operations. So interest expense could be found under profit and loss. It is just under the total turnover. You can see that for ICBC, instead of an interest expense, it has a net interest income. So therefore, debt servicing ratio is 0% for ICBC, which is good. So if we put everything together for ICBC thus far, this is what we get. A 2 out of 3 pass for our first step. For positive growth rate, it is a fail because ideally we want more than 10%. Competitive advantage is a pass. High ROE is a fail. And for reasonable debt, because of this high rating, I will rate it as a fail as well. Next, we move on to look at the valuation as well as the dividend yield of ICBC. To value banks, we will be using a simple ratio of the price to book ratio instead of the discounted cash flow valuation method that I've been using for the other companies. This is because for financial companies, such as the banks, a discounted cash flow model would not be accurate. So in order to get the price to book ratio, go over to AA Stocks and click on Basic Information. Scroll down, and here you have it. The PE of ICBC is currently at 4.77, and the price to the net asset valuation, or in other words also known as the price to book, is at 0.5458. For price to book ratio, anything less than 1 is to be considered undervalued, and anything more than 1.25, to me, I consider them as overvalued. And in between this range, I'll consider the bank to be at fair valuation. Alright, so clearly in this sense, ICBC is undervalued company right now, with a price to book of only 0.54. Now, if you go over to Simply Wall Street, click on the third section, which is valuation, you can get more information on the valuation as well. For Simply Wall Street, they have their own valuation model, which you can dig deeper and understand more if you are interested. And from their model, they are valuing ICBC at a value of Hong Kong dollars 14.31, which I think is a bit too much. So always take these figures with a pinch of salt. What we are more interested in is the price to book ratios under Simply Wall Street. And here you can get a similar reading. For the company itself, it is standing at 0.5 times price to book. So therefore, it is considered to be undervalued as well. And under Simply Wall Street, they also have the industry price to book level as well as the market's price to book level. So just some additional figures for you to compare and think through. And lastly, we come to our final step, which is the dividend yield of the company itself. For this, go back to ICBC, and under the same page where we have left off, the basic information of the company, you can get the yield of the company. And for ICBC, it is 6.41%, with a distribution of 0.29 Hong Kong dollars. When we talk about dividend, you can find out more about their dividends over at Dividend History. And when we talk about dividends, I also like to pay attention to their payout ratio. Payout ratio is a ratio of the total amount of dividends being paid relative to the net income of the company. Right, so this ratio tells us how much money the company is paying in terms of dividend, and the rest is kept on hand to reinvest in growth or to pay off debt. So in this sense, although the dividend yield is good, we want the payout ratio to be at a level where the company can manage and function properly as well. If the payout ratio is too high, the company may have problems making ends meet with their normal operations as well as to finance off their debt. And for ICBC, payout ratio is standing at 32%, so which is a rather fair and comfortable level for me. Alright, so in summary, these are the figures for ICBC. Valuation wise, it is a pass, price to book of less than 1. When talking about dividend investing, I would like the companies to have a yield of more than 6%. So this is a good pass as well. And most importantly, the payout ratio for ICBC is not at ridiculous level. 31% should be a comfortable level for the company to manage. Alright, so that is for ICBC itself. For the remaining two banks, I'll just be showing you the screenshots from the websites that I've showed you previously. With that, let us take a quick look at the stock price of ICBC. This is the daily chart of ICBC. It is currently at 4.6 Hong Kong dollar per share. Over the past 2 years or so, although the chart doesn't look very nice, with the price being in a downtrend, do remember that banks are cyclical companies. If we zoom out further to take a look at the monthly chart, this is the historical performance of ICBC itself. Not too bad. You can see the cyclical wave pattern of the banks. And although it is making a same high at about $7, prices are bouncing off a higher low each time. And with that, we can draw an uptrending trendline support. And it seems like prices are about to hit the trendline support again. So with ICBC being undervalued, now could be a good time for you to dollar cost average if you find value in the bank itself. Or you can also wait for a dip down to the trendline support and show a bounce before starting to accumulate position in the bank itself. Don't forget that options are also available for ICBC. So while waiting, you can also execute the view strategy, collect premium, and get a further discount off your stock price. The second Chinese bank that we'll be looking at is HSBC, ticker 0005. And this is the quick snapshot of its fundamentals. So for our first step, increasing profitability, we can see that the total turnover is acceptable, although with a dip from 2015 to 2016, it generally increases from 2016 onwards. So that is a pass. However, net profit and operating cash flow are unacceptable. For positive growth rate, it is having a similar figure of 6.45%, similar to that of ICBC. And this step is a fail. For competitive advantage wise, the net profit margin of HSBC is surprisingly low at 8.41 compared to the industry average of 33.56. So this is again a fail. Its ROE is surprisingly low as well, so that is also unacceptable. And for debt to equity ratio, it is at an even higher debt to equity ratio when compared to ICBC, with a reading of 13.1%. And likewise, for HSBC itself, it has a net interest income, so there is no debt servicing ratio. But overall, this step is still a fail. Next, for valuation, price to net asset valuation of HSBC is also standing at 0.5, so this is good. HSBC is undervalued. And HSBC has a dividend yield of 6.71% with a distribution per share of 2.33 Hong Kong dollars. However, one thing to take note is that the payout ratio of HSBC has been surprisingly high throughout the years, at over 70% and even going up to 700% and 100%. So this would be something that you might want to take note of and dig deeper into the company's fundamentals and financials to see if they're able to manage and keep up with this rate of dividend payout. And in fact, due to the UK regulations, HSBC have been forced to suspend their dividend payout for the entire of 2020. And there is no indication of when this suspension will be lifted and HSBC will be allowed to continue paying dividend again. If we look at the monthly chart of HSBC, it doesn't look very good as well. Prices are making lower highs and also making lower lows. In fact, prices have already reached a level that has been visited by the bottom of the 2008-2009 financial crisis. With that, let us move on to our last bank of today's analysis, and that would be the Bank of China. For Bank of China, revenue is good, has been increasing consistently for the past 5 years, as well as the net profit. But cash flow from operating activities is a fail, and especially concerning is that it is recording a negative cash flow for the year of 2019. So this might be something that you would like to dig deeper into and understand more if you are currently holding a position in the Bank of China or you are thinking of investing into it. For positive growth rate, Yahoo Finance awarded it a growth rate of 10.01, a pass under our criteria, while Simply Wall Street has a growth rate of 5.4%. Next, for competitive advantage, it is also a pass with 35.45% in terms of net profit margin as compared to an industry average of 33.56. High ROE once again is a fail across all three banks. And for reasonable debt, once again, we see that all banks have an extraordinarily high debt to equity ratio. And for debt servicing ratio, it is at 0% because it is receiving a net interest income. For valuation, it seems like the Bank of China is the most undervalued of all the three banks that we have looked at today, with a price to book of only 0.37. And over at Simply Wall Street, price to book ratio is at 0.4 times, similar to that of the industry. So this step is a pass. And lastly, for you, the dividend yield of Bank of China is the highest at 8.05%, with a distribution per share of 0.21 Hong Kong dollars. It seems like the payout ratio is reasonable as well, hovering between 31%. So this level should be manageable and comfortable for the bank going forward. Next, for Bank of China, stock prices is facing a resistance at about 480. The stock is also making a higher low during each bounce, and this allows us to draw a trendline support. Until recently in 2019, prices broke through this support and is currently on its way down. So where will this downtrend bring us to? I don't see any visible support areas other than the one over here, and this will be at a price of 210. So it may be a good idea to wait for prices to visit this level and show a bounce off before getting a position into the Bank of China if you're interested. And while waiting, you can also consider some option strategy to collect some premium. Alright, so that's all for the three banks that we are looking at today. If we summarize their results, we see that in terms of business profitability, both ICBC and Bank of China is performing better than HSBC. And for growth rate, it seems like all three banks are about the same, with an average of maybe around 6% growth rate per year. For competitive advantage, both ICBC and Bank of China passed. For high ROE, likewise again, all three banks have a lower than 15% ROE. But amongst these three, ICBC is slightly better than the two, with almost 12% in terms of ROE. And likewise, for reasonable debt, it seems like the usual debt criteria that I've been using for the other companies are not suitable for banks at all, because all three banks have registered an extra high level of debt. And amongst these three banks, HSBC is the highest, while ICBC is the lowest at only 10.2, with Bank of China not far off at 10.5%. And in terms of valuation, Bank of China is the most undervalued at 0.38 price to book. Likewise for you, Bank of China is also the best. For HSBC, take note that although they have a dividend yield at 6.71%, this figure is a lagging figure. Currently, HSBC has suspended all their dividends until further notice. And if you take into account the price action of the stocks, ICBC looks the safest, For HSBC, it is making lower highs and lower lows, so that is definitely a no-go. For Bank of China, it is making same highs and higher lows similarly to ICBC until recently where it broke through its trendline support. So for Bank of China, more monitoring would be needed, although the dividend yield and the valuation of the bank itself is very attractive. And one final thing that I would like to point out to you guys is about the option multiplier of Hong Kong shares. If you are familiar with trading options in the US market, you would have known that each option contract controls 100 shares. But this is not the same for shares that are trading in the Hong Kong market. Alright, so under Interactive Brokers, which is the platform where I trade my options, if I go over to the option chain for 1398, which is ICBC itself, and when I mouse over the expiration date, you'll get to see the multiplier of the option itself, and it is stated as 1,000. So what this means is that each option contract will control 1,000 shares of ICBC. Alright, so this is something important and to take note of when executing your options trade. Make sure that you have the sufficient cash in your account so that you are selling a cash secured put and not a naked put itself, which can be very dangerous and may blow up your account easily. Feel free to drop a comment below to let me know what you think of the analysis. Which one are you more inclined to invest in? And at this point, if you're still with me, I would like to welcome you to our newly formed Telegram community chat group where we have a higher level of discussions amongst members, active sharing of trade and investment ideas. Thank you so much for watching, and I look forward to seeing you in the next video.